I'm John Sage, Senior Director and Head of Private Credit Research. And today, I'm joined by two of my KBRA colleagues, Ken Egan from our Sovereigns team and Karim Nassif from Project Finance. Today, we will be covering KBRA's outlook for the European project finance and infrastructure sector from our report titled 2025 European Project Finance and Infrastructure Sector Outlook, Resilient Amid Headwinds. For those looking to learn more, the report was published on December 20th and can be found on our website, kbra.com, along with all of our other reports on project finance and sustainable finance. Let's dig in. The report tackles how PF&I will be shaped to a large degree by the macroeconomic backdrop in Europe. Let's start with you, Ken. How do you see the macroeconomic and commodity price environment evolving in Europe over 2025?
Yeah, thanks, John. We expect the macroeconomic environment to improve slightly in 2025, while growth conditions in Europe are expected to remain somewhat subdued. A potential for some softening in rates should continue to be supportive for the sector. Rising consumption and increased investment on the back of easing monetary policy should support overall growth. More broadly, I'd note that in today's interconnected global market, policy decisions in the US have the potential to significantly influence Europe's economy and business prospects in the PF&I space. It's important to highlight the potential impact the incoming US administration's policy direction may have on the macroeconomic and commodity outlook. Despite likely continued volatility in oil and gas and general power prices in 2025, KBRA sees the potential for a relative softening in annualized commodity prices over the next 12 months. The expectation is underpinned by high gas storage levels, healthy supply and demand fundamentals, with ongoing renewable supply, barring, of course, any materially disruptive geopolitical events. Last year was marked by a continued broad reduction in commodity prices in the first half of the year relative to spikes experienced in 2022 due to the Russia-Ukraine conflict. For example, European power prices fell 33% in Q2 2024 year over year. The more benign gas price environment reflected, among other factors, the improved security of European gas supply following the expansion of LNG regasification capacity and the rerouting of LNG to Europe from Asia, as well as weaker growth in China. As a result, Europe's gas storage levels were at 95% full capacity in October last year, exceeding the target of 90% by November. That said, volatility in gas, oil, and power prices persisted this year, with markets like Spain experiencing negative electricity prices for the first time on record, with 3 consecutive hours of negative prices registered on 1st of April. Despite subdued Brent prices, European wholesale electricity prices ticked up between October and November 2024 relative to H1 2024. The volatility in oil prices followed a combination of ongoing political tensions in the Middle East and Russia-Ukraine, slowing growth in China, and OPEC decisions on supply. I guess just to highlight for listeners that bear in mind, although these prices could soften from current levels, when we take a step back, it's important to note that they're still much higher than their average price level prior to the pandemic, if you take the years, say, 2015 to 2019, which is an important consideration in terms of the input costs for firms and inflationary aspects too.
Thanks for setting the scene, Ken. Turning to you, Karim, what do you think this macroeconomic backdrop and commodity price environment will mean for PF&I specifically?
Thank you, John. Well, Ken has highlighted the macroeconomic backdrop, the possibility we would have interest rate reductions and more attractive conditions for PF&I in 2025. Now, driven by EU policy and regulatory reforms that we continue to expect linked to the energy transition, and coupled with new opportunities in digital technology, we expect these trends to continue to sustain volumes of PF&I asset financings in 2025 and beyond. Now, these assets will continue to absorb large pools of capital waiting to be deployed by infrastructure funds, asset managers, pension funds, and private equity firms with dedicated infrastructure divisions. The confluence of capital supply and investor demand, we think, will ensure continued growth in PF&I funding beyond the traditional pools of bank and capital markets as funders in favor of continued disintermediation by private credit Now, there's two areas that we have highlighted here in terms of beneficiaries, two specific sectors. One is the renewable sector. As Europe tries to meet ambitious clean energy targets through 2030, KBRA expects continued reliance on private markets to supplement public funding and help close the funding gap. Whilst traditional renewables like solar and onshore wind will benefit from the various historical initiatives by the EU, including the European Green Deal, Power EU, Fit for 55, and the RED III, many of these schemes set specific targets, not just for the medium term 2030, but beyond 2040 and 2050, leading to material funding requirements from both public and private sources. What's new and interesting is that key stakeholders now across national and EU governments are identifying what they see as the next phase in the energy transition, which will be spearheaded by a potential industrial revolution around decarbonization and renewable energy. This will entail lower subsidies for established traditional technologies, coupled with greater regulatory policy and funding support for less established technologies such as hydrogen, floating offshore wind, electric vehicle charging, battery storage, and carbon capture and storage. Now, capacity markets and contracts for different schemes have supported traditional renewables in the past. There is a potential, therefore, to use such schemes to support the new asset types. Now, alongside the traditional renewables and emerging clean energy technologies, the second sector we're looking at here is digital technology as a boon for the PF&I market. While telecommunication, tower, and fiber to the home transactions have been a feature of PF&I funding over recent years and are reaching a stage of relative maturity, data centers are emerging as particularly attractive as a new asset class given the demand projections. Whereas data center financing has been typically achieved through structured and/or corporate real estate arrangements, PF&I is increasingly taking the center stage to fund transactions, for example, of a hyperscale quality. These transactions involve off-takers committing to a hell or high water or triple net lease, usually about 10 or 15 years in tenor, which covers the running costs and delivers a predictable level of free cash flow to the developer. Asset managers like BlackRock and Aquila Capital have established digital funds to capitalize on data center investment.
It's very interesting, Karim. But what do you see as the potential headwinds?
So despite this, what might characterize as broadly benign environment, there are challenges that were witnessed in 2024, which we think will persist in 2025. We've identified three in particular: regulatory and geopolitical risk, which we see as one element, merchant and recontracting risk, exacerbated by commodity volatility, particularly power prices, which we see as a second, and the third, climate change risk. So while KBRA expects power price volatility in Europe to persist next year, we also expect that well-structured projects will exhibit continued resilience. For example, the more robust credits should be able to survive periods of intra-year low prices because of sufficient buffer in terms of free cash flows to debt. In certain markets, regulatory matters will come to the fore. Let's consider Spain, where traditional power generators, such as solar plants, face uncertainty in regard to receiving adequate subsidies on initial investments in a climate of zero or negative power pricing. The introduction of new taxes on renewable energy production, such as the resort rent taxes introduced in Norway, may impact the viability of some projects. Similarly, regulation and policies relating to permitting will continue to be important for PF&I assets and related financing structures. For example, in offshore wind, permit delays can lead to a significant interval between the date the auction is awarded, the final investment decision, and actual commencement of construction, with the possibility of meaningful changes in market conditions during this time. Other political and in some cases geopolitical developments may render a commercial contract award uncompetitive, requiring a further period of commercial negotiations between developers and the regulators and/or government. The third area that could create headwinds is climate change, particularly warmer weather conditions. These can cause fluctuating power demand, for example, which can threaten PF&I transactions with exposure to the energy markets. Physical risks are also an area of growing concern given the vulnerability of project assets to natural disasters. Greater scrutiny will be placed, in our view, on insurance coverage terms and conditions as market participants seek to mitigate some of these climate change risks. Compliance with environmental standards, including adherence to Scope 1, 2, 3, and 4, as well as those under the Corporate Sustainability Reporting Directives, is also an area that can add costs to certain transactions in the PF&I space, for example, for ports and airports, and may become a more material liability over time for certain sectors as pools of funding become contingent on meeting minimum environmental standards.
So in light of those regulatory, commodity, and climate change risks, how has KBRA's European PF&I portfolio performed in 2024? And it'd also be great if you could touch on what you expect for the year ahead.
So to give some context, KBRA's European PF&I portfolio includes a higher mix of investment-grade issue ratings with both senior and junior debt included. Moreover, most of the entities currently hold a stable outlook. The majority of KBRA's PF&I ratings in Europe are private and issued at the direct request of the investor or issuing entity. Over the past year, KBRA has affirmed 91% of its portfolio ratings, with the remaining actions constituting 6% downgrades and 3% upgrades. So the relative stability that you can see here of European PF&I performance in 2024 was supported by the slightly improved economic conditions with a relative softening in commodity prices. The greatest credit vulnerability in our portfolio in 2024 was entity financings linked to power generation in markets that have experienced material swings in power prices and where regulation or contract arrangements were insufficient to fully mitigate that volatility. We've also noted that weather events and supply chain issues have led to delays in project ramp-ups, constraining availability. Finally, some of our rated power projects have been exposed to fluctuating regulatory policies linked to historical periods of high power prices back in 2022, 2023. New fiscal policies, such as the resort rent taxes introduced in Norway, are intended to make power prices more affordable to consumers by redistributing profits from power producers back to individuals. However, depending on the transaction fundamentals, this can expose the transaction to weaker earnings over time. The upgrades reflect the successful execution of rollout strategies in the telecom space, a maturation in terms of free cash flow generation, and a favorable environment supporting strong demand.
Thanks, Karim. Sounds like the performance of our PF&I portfolio was quite stable in 2024. And 2025 might be another attractive year for issuance. With that, I wanted to thank Karim and Karim for the discussion, which brought up a number of important topics. We hope this conversation in KBRA podcasts helped to illuminate the many trends taking shape across the PF&I market today. For more in-depth coverage, or to learn more about our unique approach to credit, sign up on our website to read all of our research. Do you have a topic or comment you'd like to share? Reach out to Ken, Karim, or myself. Be sure to rate, share, like, and subscribe to this podcast. Invite your colleagues as well. This is John Sage, thanking you for being part of the conversation. Take care.